Welcome to the Explainer. You know, in the world of trading, some patterns are just classics for a reason. And today, we're going to break down one of the most famous and reliable ones out there, the cup and handle. Okay, so here's our game plan. First, we're going to see where this pattern came from. Then we'll get into the nitty-gritty of what it actually looks like. After that, a simple 3-step playbook for how to trade it. And finally, and this is super important, we'll talk about how to avoid getting faked out by a false signal. So first up, let's take a quick trip back in time. Because to really understand this pattern, you gotta know where its story began, all the way back in 1988. Okay, now this is probably the most crucial thing to get right from the start. This is a bullish continuation pattern. That means it is not signaling a reversal from a downtrend. Nope. This is all about a stock or an asset that's already in a strong uptrend, and it's simply, well, taking a pause. It's catching its breath before continuing its climb. And the man who really put this pattern on the map was the legendary investor William J. O'Neill. He had this brilliant way of looking past the lines on the chart and seeing the psychology behind it. He framed it perfectly as the market consolidating, building up energy for its next big push higher. So the pattern's journey is pretty fascinating. It always kicks off with an existing uptrend. Then, in 1988, O'Neill basically codified it in his classic book. But what's really amazing is that today, that same core logic he laid out decades ago is still being applied across all kinds of modern markets, everything from stocks to Forex to crypto. Okay, so we know where it comes from. Now let's dive into the anatomy of the signal itself. What exactly are the two key components a trader needs to be looking for on a chart? First up, you've got the cup. This is the biggest part of the formation. You're looking for a gradual U-shaped recovery. That slow, rounded bottom is so important because it shows that the selling pressure is finally fading out and a really stable price base is being built. Then, after the cup is complete, we get the handle. Now, this is a much shorter, slight downward drift in price. You can almost picture it, right? It's like one final shallow dip that shakes out the last few sellers right before the buyers are ready to step in and take full control. And this distinction right here is absolutely critical. You have got to see that rounded U shape for the cup. It signals that gradual consolidation, that stability. A sharp V shape, on the other hand, well, that just screams volatility. It's a whipsaw reversal, it's way too aggressive, and it's not that healthy pause that we're looking for. So let's just put this all together into a quick mental checklist. First, you ask, is there a significant uptrend before the pattern? Second, does the cup have that nice, rounded, U-shaped bottom? Third, is the handle a shorter, downward-sloping consolidation? And finally, has the price made a decisive breakout? If you can tick off all those boxes, you've got yourself a valid setup. All right, now that we know how to spot it, how do we actually trade the thing? Let's walk through a really simple, systematic 3-step playbook that covers your entry, your stop loss, and your profit targets. The whole trading plan really just boils down to 3 key decisions. First, you've got to find your entry point. Then you've got to set your critical stop loss, your safety net, and finally, you calculate your profit target so you know exactly what you're aiming for. And you really have a choice in your approach here. If you're a more aggressive trader, you might enter while it's still in the handle to get a better price. It's definitely higher risk, but the potential reward is bigger. The conservative trader, though, is going to wait for the price to actually break out first, placing a wider stop. It's that classic risk-reward trade-off. And here's the real beauty of this pattern. It takes a lot of the guesswork out of the equation. It literally comes with a built-in formula for setting your profit target. You just measure the depth of the cup, and then you add that value to the breakout point. That gives you a logical, data-driven minimum price target. It's beautiful. So let's make this concrete. Just as a hypothetical example, say you're looking at Nvidia's stock. The price breaks out at $950, and the depth of the cup measures out to be $200. Well, you add those together, and you get a projected target of $1150. It's a clear, actionable plan that's based directly on the chart's structure. But listen, no pattern is perfect, and that brings us to what is arguably the most important part of this whole explainer: how to avoid that dreaded false breakout and protect yourself from a fake signal. So you see the pattern forming perfectly on the chart. I mean, it looks textbook, but how do you actually know it's a real signal? What is the one thing you absolutely have to check before you act on it? The answer is volume. Volume is your lie detector. A breakout that happens on low, weak volume is a massive red flag. It suggests there's no real conviction behind the move. But a breakout that happens with a huge surge in volume, that is your strong confirmation. That tells you the big money is interested and the move has real power behind it.
Now, beyond just volume, professional traders are always looking for confluence. That's where multiple signals all line up and agree. For instance, is the handle forming above a key moving average, acting like a price floor? Is the RSI showing momentum is starting to turn up? Or are the Bollinger Bands squeezing really tight? It's all about building a stronger and stronger case for the trade. And finally, let's talk about the common mistakes to avoid. Don't jump in before the handle is fully formed. Be patient. Never, ever ignore a lack of volume on the breakout. Always have your stop loss and target defined before you even enter the trade. And remember, this pattern is just way more reliable on longer timeframes where there's less market noise. Avoiding these pitfalls is just as important as spotting the pattern itself. So, the cup and handle gives us this powerful blueprint, one that's really grounded in a market psychology that has stood the test of time. But that leaves us with one final, pretty important question to think about. This pattern was popularized way back in 1988. So in today's high-speed algorithmic markets, does a simple teacup still hold the key to a trend?